Welcome to the channel. My name is Langers and I am the Scruffy Trader. And why am I scruffy? Well, just take a look at me, because I ain't no Brad Pitt. Oh, hold on. Here's somebody who thinks I'm Brad Pitt. What you got?
Your coffee.
She got my coffee. Look at that little pixie hat and a coffee, because we all know Scruffy likes a coffee. Anyway, sorry about that interruption. She always wants to be the star of the show. Never mind. So what am I doing today? Well, today one of the lads on the Facebook group has asked me if I would look at scaling and targets, and I'm more than happy to do that. So what does that mean? Well, in trading we're here to make a profit, and as I constantly say, I'm here to be paid, because this is my job. It's what I do for a living. And the way that I'm paid is I use scale points, because I can have a target and it can be 2 to 3 times the risk. But what if it doesn't get there and it comes back and takes me out of the equation? I've earned nothing. So I have scale points on the way up to that target, and that way I'm paid. And I'll explain that on the charts. I'll show it in just a second. But it is a big argument amongst traders, and the argument is always the same. You know, you've got those that believe in scaling like myself, and then you also have the other side that think you should just have a target and that's it. You go to your target and you either win or you lose. Well, I kind of disagree with that, but the thing with these videos are that they're all based on my trading style and how I make a profit, and I only work on making a profit. Simple as that. And I've been accused of being a scalper and all sorts. I'm not a scalper, because I'm not looking for 2 or 3 ticks. I'm looking for as much as I can get out of a move that is safe and can generate a decent profit. And because I'm a day trader, those moves are probably around 30 ticks, maybe 20, but that's as much as it's going to move safely. So to me, there's a difference between scalping and day trading. But anyway, let's jump on the chart and we'll see if we can kind of make a little bit of sense of scaling and target. And I'll show you a way to trail a stop to lock your profits in. But the stop primary use is to protect your account. But we'll go through it on the chart. So come with me and let's see what we can find. Okay guys, here we are. We're on the chart. Oh, look. This could be another coffee.
It is.
It's the Pixie. Thank you very much. Doing well today. 2 in 1 show. Fabulous. It was a long night last night. I really need a coffee. Anyway, back to what I was talking about. Standard chart. Euro dollar daily chart. And the debate is always the same. It should be 1 to 2. Take your medicine, take it or leave it, or scale out as you're going up to a similar target. You can kind of make your own mind up as to who's right and who's wrong here. So let's have a little look and see which is better. So here's the chart, and it's a simple euro dollar chart, and I'm going to show you a basic premise of a trade. It's not a major setup, but it's a standard trade, and we're going to look to see whether scaling or targets is the better of the two. Okay. So the premise here is you've identified a downtrend, and what you've seen is 1, 2, 3, 4, 5 waves. All right. And on this wave, you're seeing that it's definitely slowing down because it's not as strong. Okay. And in the textbook, 5 waves, goes into consolidation, turns around, goes up. All right. So that's the first tick box. You've then drawn a trend line in, which is going to be your trigger. So what you're looking to see is the price to come breach the trend line, stay above the trend line, retest it, and then go back above it. Standard stuff. Okay. So this is what we're looking at to start with. So you've seen it come down, you've seen the waves slowing down, and you're looking for a little bit of consolidation to see that your play is right and a low point. So there you are. It's not getting any lower, and you can see the consolidation here because it's tried, it's gone back, it's tried, failed, gone back, failed. All right. So you genuinely think that your position is going to be long. All right. So let's just have a little look and see what happens. Okay. So yes, there's your breach. First part of the game. Excellent. Let's keep it going. It's kind of stayed above it because it's closed slightly above the line. There you go. It's definitely above. We're now looking for it to come back and retest, and it has. So excellent. There's our game. This candle here. So that is the entry point just above the candle. And because we're looking at the traditional way of doing things, not my way, just the traditional way, your stop is a few ticks below that candle. Personally, I'd have had it under here, but the traditional way of doing this on a trend line is there. Okay. So you've defined your entry and you've defined your risk. So what's that? So we'll measure the two. And it's 99, let's just say 100 for argument's sake, to keep figures relatively simple. It's 100. And you're looking for a minimum of 1 to 1.5. That's your minimum. Whereas normally you're looking, they'll say you have to be 1 to 2, 1 to 3 sort of thing. But let's just err on the side of caution and just say it's 1.5 times, which is still a good return. Okay, so you're looking for 150 pips out of this based on this risk and this entry. So we'll get a little measuring tool and we'll see where 150 pips takes us. Okay, so that puts us there at that level, which is at 146. Okay, so I want this green line at 146. Okay, so we've now got a risk and a reward. Let's see if this balances up to make certain that you would be in the realms of possibility. So you look to your left, and sure enough, there's some structure points. So everything's in your favor. This is looking pretty darn good. Okay, so let's play it out. See where it goes. Going, it's going. Oh no, 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 no! It's coming back. It's coming back. Oh no, no. Oh no, oh dear. Oh no, I'm out. That stopped you out. Right. Now let's think we're doing it the way that I do it. All right. We know the entry point was here. And I might still have a target up here. But what I would do, and this is just my measuring tool, by the way, guys. It's not a true Fibonacci. This is just the way that I do things. I break the trade up into 5. I always do. I always have 5 positions on. And the reason being is 1, 2, 3, 4, and the 5th one's left to run. So I break the trade into 4 target points within the initial target and a last one to run just in case it does keep on going. So they're always telling you that you have to win more than you lose, which is right. But I would rather have 3/4 of a winner than 100% of a loser. And that's my theory. And if you look at this, I'd have been paid here and I'd have been paid there. And as soon as that bit's paid, I go to break even. Always do. As soon as the second position comes out, I go to break even. So this is now not in the equation. I've been paid and I can lose nothing. And all right, it didn't get that far and it came back and stopped me out. But I earned more than the other guy because I still got half paid and I did it risk-free. And the argument behind it is always, oh, well, you've got full risk on at the point of entering. Yes, I do. But
So have you. You're still risking exactly the same amount as I am, but I got paid and you didn't. And that's the argument, guys. And that was just a basic example of why scaling overcomes targets. And you talk to many professional traders and they do scale out, but they also scale in. It just depends on the strategy. But for the purpose of what we were doing, you should, in my opinion, this is just my opinion, guys, be scaling out, because you want to be paid for what you do. The way of looking at this, the way that I look at, is I'm paid here, I'm paid here, I'm paid here, and I'm paid here. Fabulous. The target trader will say, well, I got paid more than you because I got to target. Yes, you did on that instance. But what if that target kept on going? The fifth trade then starts giving me extra. And it always gives me extra. Because that might run to 5-1, where you wouldn't have dared go into it. But I can do that risk-free. And I'll have a trailing stop running behind a 34 period moving average. That ensures that I'm constantly paid. And it also ensures that if the market does come back against me, it doesn't give away everything that I've earned. So across the long term, I earn more money. And this has come from years of doing this. This isn't just something that I've thought, right, this is how it works. I used to be a target trader constantly. And all I ever did was follow the rule book. There's my risk. I need to be 2 times that risk to the nearest structure point, and I'll make money. I didn't. I lost a fortune. But then I started scaling out, and I started not looking at the markets the way target traders look at markets. I stopped listening to morons on forums who say, oh, you have to do this and you have to do that, and this structure and supply and demand. It's all rubbish. We're in it to be paid. I don't care how you get paid, but be paid. But then I break it down and I'm paid all the way up. Management. And part of money management is getting your money out of that market. And that's what I'm doing. So I go in, second scale point, I'm at break even, can't lose anything. And if it comes back and takes me out, I'm not bothered. It just means that trade is complete and I still got paid. So you tell me, who makes the most money?
So that's a little bit of insight as to why I scale. And the reason why I scale is because to me it's a job. And a job needs to pay for things like this. And I have to keep little Winky happy. But I also need to keep the bank happy as well. And I do that by little and often. And all of these trades that I take add up. And when you look at my P&L, it looks like I've taken a magnitude of trades. So I can understand why people will say that I scalp. But I might actually only trade once, twice a day. But because it's broken up, it ensures that my account is protected and it's constantly having money drip fed into it. So I kind of hope that makes sense. Anyway, test it, do whichever you think is best. As long as at the end of the month you have money in the bank, then it's a winner. And that's it, guys. Simple as that. You know, because we're all in it to be paid. And that's all I want for you. Because there's too many who'll say, no, you must go 1 to 3. And think about how many times it comes and stops you out. And there's a lot more to this because it's to do with stock placement, your position size, the correct entry. And you add all of these things together to help make you profitable. All right. And that's what these videos are for. And I do genuinely hope to help you. And as I'm helping you, please help me by clicking that little subscribe button down here. Click a like if you like this sort of content. And ask a question below. And I'll answer it personally. And if you want a video made to clear something up and put it into a plain English way of understanding it, rather than the psycho babble that you see on the forums, I'll do that for you. Because as I say many times, trading isn't complicated. And I often find the ones who look to make it complicated are not profitable. In fact, they're not even scratching the surface, but they like the sound of their own voice. So there you go. Happy days. Do what you love and the money will follow. I'll see you on the next one, guys.